Before we start this video, do like and subscribe to our channel and not miss on any updates.
Good morning. So yesterday we completed Accounting Standard 4 and today we'll continue and complete Accounting Standard 5, and after Accounting Standard 5 we'll start with Accounting Standard 9. Okay. So initially we did a lot of computation related standard. These are more theory related standards. Again we'll move back to computation related standard, right? Now, as far as Accounting Standard 5 is concerned, this is a simple standard like Accounting Standard 4. There are few concepts that you need to be aware of. Then it is more about writing those concepts, applying those concepts in the scenario given in the examination. Okay, and please ensure in this standard, remember the definition and the concept, right? Now, what does AS5 deal with? It deals with net profit or loss for the period. That is, how do we determine the profit or loss? Prior period items and changes in accounting policies. Three things. Largely you get questions on prior period items and changes in accounting policies. Okay. Now, AS5 is applied by an enterprise in presenting profit or loss. So when you are preparing the profit and loss account from ordinary activities, these are your day-to-day activities. Ordinary means on a routine basis, like for example, purchase of goods, sale of goods, right? Where the enterprise engages on a day-to-day basis, that is called ordinary activities. Then extraordinary items. Now extraordinary items are those which are not ordinary items, which are maybe like a one-time item and is not expected to occur regularly. For example, a fire broke down, a fire occurred, right? When a fire occurred and there is a damage to, let's say, inventory or damage to the premises, that is called extraordinary item. And then we have prior period items. Now prior period items means there has been some error or omission. These are the keywords. There has been some errors or omission in one or more previous period, and that has been detected in the current period. Now what is the meaning of errors? Say for example, we calculated depreciation incorrectly. Okay, it is not that the estimated life was different. We calculated depreciation incorrectly, or we totaled the value of inventory incorrectly when in the previous period. In the current period, we identified that, oh, we made a mistake. Now we have to rectify it. Those are called prior period items, right? So we have in P&L, ordinary activities, your routine transaction, extraordinary activities, one time which is not expected to reoccur frequently, and prior period items which are errors and omissions from the previous period. That is the first aspect. Then it also talks about accounting for changes in accounting estimates. What do we do when we account for changes in estimates and changes in accounting policies? So whenever you get a question on any of these, something should strike in your mind that this question has come from Accounting Standard 5. Now what are ordinary activities? These are undertaken by the enterprise as a part of its business and related activities in which the enterprise engages in furtherance or incidental or arising from these activities. So for example, purchase of goods. Now when I am purchasing goods, of course there will be transport cost incurred. I have to store those goods. I have to take a warehouse on rent. Anything which is my part of my business, my buying and selling transaction, or my manufacturing activities, or my service activities, and related activities to this part of business. So for example, just to give one more dimension, I am taking classes, okay, or we record classes. Now we also conduct live classes. Now these are also related to we offering classes to the students. Those are called ordinary activities. Then what are extraordinary items? This is very important. You have to learn this definition. You have to learn this definition because this is what will give you extra marks whenever you write in the examination. Income and expenses that arise from events or transactions that are clearly distinct from the ordinary activities and therefore are not expected to recur frequently or regularly. So fire occurred, large part of assets have been sold, okay, or a significant customer went bankrupt, something which is not expected to occur frequently, that is what we classify under extraordinary items. Now sometimes what happens is there are ordinary activities which are exceptional in nature. Okay, so day-to-day transactions, but the value is significant or the kind of transaction is significant, then we say ordinary activities which are exceptional in nature. Extraordinary, once in a lifetime, not once in a lifetime, but very less occurrence. So for example, we purchased another company. Okay, when you purchase another company or when we sell a subsidiary, these are extraordinary activities because these are not expected to occur frequently and they are distinct from the ordinary activities. So what is ordinary, what is extraordinary, we have seen. As far as extraordinary items are concerned, we have to disclose the extraordinary items separately. We have to disclose extraordinary items separately. That is the logic. Then prior period items. What are prior period items? As we discussed earlier, income and expenses, here we talked about it, which arise in the current period because of error or omissions in the preparation of financial statements of one or more prior periods. We did some mistake in the past and we identified that mistake now, and now we have to rectify. And when we rectify, we have to record an income or expense. For example, as I told you, depreciation calculated incorrectly. Okay, we knew the rate of depreciation is 20%, but what did we do? 10,000 into, instead of doing 10,000 into 20%, we did, let us say, 9,000 into 20%. So what happened? This is right, this is wrong. So this is 1800, this should have been 2000. So what do? This difference of 200 we will record in the current period. Okay, I am not talking about changes in estimate of useful life or changes in estimate of residual value. We applied the rate to the wrong amount. That is called prior period item. Then we have accounting policies. What are accounting policies? These are principles and the methods of applying those principles adopted by an enterprise in the preparation and presentation of financial statements. Now, when you look at a financial statement, there are multiple different items in the financial statement. For example, inventory. Okay. Now, inventory, you can value inventory using multiple methods, FIFO, weighted average, LIFO, and all of that. So, the accounting principle and the method of applying those principles. Which principle am I applying? Which method am I applying? How am I applying that accounting principle? Which is adopted by an enterprise in the preparation and presentation of financial statement. So, you can have accounting policy related to inventory. You can have accounting policy related to PPE, cost model or revaluation model. Okay. Then, so that is one more aspect where you are choosing an accounting policy. Then accounting policy related to, let us say, accounting standard 11. Will we capitalize the exchange losses or will we write it off to the P&L? All of those are accounting policies. Okay. So quickly, ordinary activities, these are day to day, these are part of the business, these are related to the business, and any other activity which is carried out to carry on the business. Extraordinary items, these are distinct from the ordinary activities. So what you have to understand is these keywords are important. These are distinct from the ordinary activities. These are part of its business. Then prior period items, error or omissions, and accounting policies, specific accounting principles and methods of applying those principles which are adopted by the enterprise in preparation and presentation of financial statements. Now, this part related to net profit or loss for the period, this is not very significant, but still we have to learn it. All items of income and expenses which are recognized in a period, whether from ordinary activities or from extraordinary activities, should be included in the determination of net profit or loss for the period. This is something which we clearly know. Okay. The net profit or loss for the period comprises of P&L from ordinary activities, that is you have to disclose, and extraordinary items. The impact of extraordinary items should be disclosed on the face of the statement of P&L separately. So, even if you prepare Schedule 3 financial statements, even there, the impact of extraordinary items you have to disclose separately. Okay. Now, profit or loss from ordinary activities which are part of the business, for example, sale of merchandise, loss on sale of inventory, etc. Then there could be ordinary activities of exceptional nature. That is what I was discussing, right? So, if disclosure of an item of income and expense from ordinary activities is relevant to explain the performance of the enterprise, the nature and amount should be disclosed separately. That is called ordinary activities of exceptional nature. So let's say huge write down of inventory. Okay, huge write down of inventory. Ordinary activity, yes, but exceptional nature. Loss of inventory, theft of goods. Ordinary activities, exceptional in nature. So how do we decide? Based on the size, nature and incidence. If it's a huge size, or if it is based on the nature also. For example, let us say there is a director. Okay, now director, you do some transactions with the director. Ordinary activities, director purchase goods, ordinary activities, but accounting standard 18, we know it is a related party, you have to disclose separately. So that is because it is exceptional in nature. Okay, so like this, some standards directly tell you that you have to disclose, but otherwise you have to see if the size, the nature, the incidence of the item is such that a separate disclosure is required, you will present it separately by calling it ordinary activities of exceptional nature. Circumstances where separate disclosure is necessary: write down of inventories to NRV and reversal of such write downs, legislative and statutory changes having retrospective application. That is one very, so for example, you pay taxes regularly. Suddenly they came up and say GST on a retrospective basis you have to pay. You have to pay GST on a retrospective basis. They will not say, but let us say there is question whether it is taxable or exempt. And so far we have been treating it to be exempt. GST came up and said, no, it's not exempt, it is taxable. So right from beginning you have to pay. So it is ordinary item of exceptional nature. Disposal of long-term investment or fixed asset, litigation, settlement. Okay. So what you have to see is, if it is ordinary, if it is routine, if the nature and amount is okay, then you will not make a separate disclosure. But if the nature, timing, incidence, size is such that a separate disclosure is required, then you need to disclose. Now the question comes, how do we decide that in the exam? We will not know whether it is material or not. So there you have to make a guess. So for example, if they say inventory loss of 10 lakhs, you can say, if we assume that this is a significant item, then we have to make a separate disclosure. Something like that you can write. Extraordinary items should be disclosed separately with respect to nature and amount in the statement of P&L as a part of net profit for the period. So when you prepare schedule 3, when we come to schedule 3, there you will see extraordinary item as a separate line item. How to determine? Based on the nature of the event or transaction in relation to the business ordinarily carried on by the enterprise. Okay, so if my business is, for example, buying and selling of computers, and suddenly I start, in one of transaction I bought and sold a car, that can be an extraordinary item. Okay, so you cannot have a blanket rule. You have to see, is it related to my day-to-day business? If yes, ordinary. If no, extraordinary. Some events that generally give rise to extraordinary item could be attachment of property of the enterprise. Government has attached the property. Earthquake has occurred. Loss has occurred. Refund of government grant, that we understand there. So all of these have to be disclosed separately. Okay. Then the next part is prior period item. Now see, what you have to understand is, in all of this, the theory part is very, very important. You understand the concept, but make it a point to learn and write it. The definition part, learn and write it, so that if a question comes in the exam, automatically you can write the answers. What is a prior period item? It's an error or omission. It is rectified in the current period, affect the current period P&L, and it is coming from the previous period. So errors of past period rectified in the current period. So it could be anything. Now how do I decide whether it is prior period or not? So what you have to ask is, when I prepared the financial statement on 31st of March, did I have the information? If I have the information and I did not account for it, then it becomes an error or omission. Or if I calculated it wrongly, error or omission. Now there could be a situation where theft has occurred in the previous period. On 31st March we did not know. By 31st May also we did not know. That the theft had occurred. Now on 31st May, financial statements have been approved. I did not know here, So this, when I finally know here, this is not a prior period item. Why not a prior period item? Because I was not aware. It was not an error from my side. It was not an omission from my side. Error or omission means either I calculated wrongly, or after being aware I have omitted. After being aware I have omitted. That is when we call it error or omission. Okay. Now, if it was identified here, then we would have adjusted. But if it is identified here, we cannot do anything. It becomes a prior period item. It becomes a prior period item. Right? So far we have seen ordinary items, extraordinary items and prior period items. Now, there are two related concepts. One is accounting estimate and one is accounting policies. So the questions are asked based on whether the following is a change in accounting estimate or a change in accounting policy. So for that, let us see. What is the estimate? Estimate is basically of an amount or quantity or life. Okay, estimate is basically of an amount. For example, provision for bad debt. We make a provision at 5%. This is called an estimate. We are estimating the amount of bad debt. Now, why do we call it an estimate? Because we cannot determine the exact amount. When we cannot determine the exact amount, we say it is an estimate. It is an estimate. Now, we have to provide for bad debt. That is a part of our policy. But this amount that is calculated for provision for bad debt, that is called an estimate. Now, these type of estimates we make a lot of times. For example, useful life. Then we make estimates of residual value, right? We make a lot of estimates while preparing the financial statements. We make estimates of net realizable value. These estimates are used to prepare the financial statements when we don't have the exact amount. Now, for example, we said provision for bad debt is 5,000. Actual bad debt became 6,000. Now, this is not a problem of accounting policy. This is a problem, or this is a difference which has arisen because we made an estimate. The estimate turned out to be different. This is called change in accounting estimate. This is called change in accounting estimate. Now, for you in the examination, the best way to distinguish between an accounting estimate and an accounting policy is that you have to see whether it is something related to amount, quantity, life, etc., where the management has made an estimate. Where the management has made an estimate. Right? So, if there is a change in accounting estimate, what we'll do, we will adjust in subsequent period. We'll adjust in subsequent period. Now, one more thing. As per accounting standard 10, change in method of depreciation is a change in accounting estimate. Earlier, it used to be a change in accounting policy. Now, they have said that because one, it includes both an estimate and a policy, and hence we will use it as a change in accounting estimate only. So, this is one thing you have to remember. Changes as per accounting standard 10, changes in the method of depreciation is a change in accounting estimate. Now, why do we change accounting estimate? We change accounting estimate where there are changes in circumstances or new information has been derived or more experience because of subsequent development. Okay. Now, estimate also could be for a liability created. We have created a provision for, let us say, a suit which has been filed against us. Some party has filed a case against us, and for that case we have made a provision. Okay, it's not a contingent liability, it's a provision, or it could also be a contingent liability. Subsequently, we figured out that the amount we have to pay is higher. Okay, so that is also called a change in accounting estimate. Now, this is important. The effect of change in accounting estimate should be included in the net P&L or determination of P&L in the current period. That is, in the period when we have seen the change in accounting estimate, and current and future period if the change affects both. So, if the change in accounting estimate affects only the current period, what could that be the case? I gave you an example of bad debt. 5,000 was the estimate, 6,000 became actual. This impacts only the current period. So, this will impact only the current period. Whereas, change in method of depreciation impacts not only the current period but also the subsequent period. Change in method of depreciation, which is a change in accounting estimate, impacts the current period and all the subsequent period. So, here this line means it will impact both current and future period if the change affects the both. Okay. So that is what is to be done with changes in accounting estimate. We'll see good number of questions here because we have to clearly identify whether it is a change in accounting estimate or whether it is a change in accounting policy. What is an accounting estimate? The closest approximation of an account balance in the light of best available information. Because we don't have entire information, we use estimates. Disclosure for change in accounting estimates. The nature and amount of change in accounting estimate, if it has a material effect in the current period or subsequent period, should be disclosed. If it is impracticable to quantify the amount, the fact should be disclosed. So this also you need to remember. Okay. Now, changes in accounting policies. What are accounting policies again? The specific principles and the method of applying those principles adopted by an enterprise in the preparation and presentation of financial statement. Remember this. I told you earlier also, you have to remember this. Because whenever there is a question on change in accounting policy, you need to give the definition. Okay. Now, the question is, when can we change the accounting policy? There are three things. Again, this you have to remember. We can change the accounting policy when the adoption of a different accounting policy is required by statute or law. If there is a law which says you have to adopt a different accounting policy. Now, a typical example I would give you. We follow accounting standards. Okay, as IndigoLearn, we follow accounting standard. Let us say we become listed. Once we become listed, as per the Companies Act and accounting standard rules and Indian accounting standard rules, we have to follow Ind AS. So, the accounting policy is changed because law requires us to change it. That is the first thing. Second, for compliance with an accounting standard, a new accounting standard has been released or issued. If you have to comply with that, we can change the accounting policy. Or when it is considered that change would result in a more appropriate presentation of the financial statement of the enterprise. So, three things. If it is required by law, if it is required or if it is required by a new accounting standard or a existing accounting standard, we have to adopt it to comply with the accounting standard. Third, if it is considered that change would result in a more appropriate presentation, or you can write it as in a better presentation of the financial statements of the enterprise. Three things: law, compliance with accounting standard, better presentation of financial statement. You need to write these reasons. Okay. Now, if there is a change in accounting policy which has a material effect, that should be disclosed. So, if there is an accounting policy which has a material effect, it should be disclosed. The impact in the financial statement should be shown in the period in which the change is made, and when the effect of such change is not ascertainable, the fact should be disclosed. So, what you have to do is, for example, inventory. Earlier we used to follow FIFO method. Now we have followed weighted average method. As per FIFO method, inventory is 1 lakh. As per weighted average method, inventory became 1,20,000. Now, if the inventory value increases, profit also increases. So what you have to disclose is, you have to disclose that we have changed the accounting policy. Because of the change in accounting policy, the value of inventory has increased from 1 lakh to 1,20,000, and consequently the profit has increased by 20,000. If the earlier policy was followed, the inventory would have been at 1 lakh and the profit would have been at so much amount. Okay, that is how you have to disclose. So, any change in accounting policy which has material effect should be disclosed. Impact in the financial should be shown in the period in which such change is made. If the change has no material effect in the current accounting period, but is reasonably expected to have a material effect in the later accounting periods, the fact should be appropriately disclosed. Now the second thing what it means is, current period there is no material impact. Subsequent period it will be a material impact, that also you have to disclose. So accounting policy examination question will be either whether this is a change in accounting estimate or whether there is a change in accounting policy, or there could be a question which says when can an entity change the accounting policy and what are the disclosures requirement. Okay, so these are the things you have to remember. Now, if you are adopting an accounting policy for events or transactions that differ in substance from the previously occurring events or transaction, that is not called an accounting policy change. For example, in the past, we never had, a structured employee benefit program. Now we started a structured employee benefit program. Means earlier there was no policy. Now we have started the policy. So it is not a change in accounting policy. It is adoption of new accounting policy. Okay. Second, adoption of new accounting policy for transactions which did not occur previously or were immaterial. So if you have adopted new accounting policy, that is not called a change. If you are using an accounting policy for events that differ in substance from the previously occurring event or transaction. So earlier transactions were different, now the transactions are different. And for the new transactions, if we take a policy, it is not called a change in accounting policy. This also sometimes is tested in the examination. Okay, so just a quick recap. For net profit for the period, you have ordinary activities and extraordinary activities. Ordinary activities of exceptional nature is disclosed separately. We have prior period item because of errors in omission, you have to disclose separately. Changes in accounting policies, changes with material effect to be disclosed, estimates also to be disclosed. Okay, now what we'll do is, this notes anyways you have, you can look at the question answers. We'll focus more on examination questions. Now, November 23, 5 marks question. The accountant of Beryl Limited has asked you to identify the following items as change in accounting policies or change in accounting estimate, extraordinary items, prior period items, ordinary activities. So many things have been asked, right? You have to appropriately classify, right? First, non-provision for salary already due in the earlier year. So first thing, we have not done something that we are supposed to do. We have missed something. So how should we check? Should we directly start ordinary? No, because the residual category or the category which is specifically defined is prior period item, changes in estimate, policies, etc. Ordinary activity is the last thing because that is a day-to-day business of the enterprise. Now, payment of salary is ordinary activity. Don't say this becomes ordinary activity. This is specifically defined as a prior period item because we did not provide what we were supposed to provide. So the first one is a prior period item. Then attachment of the property of the enterprise. Now this is something. Is it related to error? No. Okay. Is it related to accounting policy? No. Accounting estimate? No. Something has happened. Now the last thing that we are left is basically whether it is ordinary or extraordinary. Attachment of property is not something that is happening as a part of our business. Okay, if it is a part of our business, then it means we are carrying out some illegal activities on a day-to-day basis. So, if attachment of property has happened, it is not ordinary activity. It is nothing to do with estimate, policy, etc. So, this we have also seen earlier. It is an extraordinary activity. Introduction of new pension scheme for employees. Now, when we introduce a new pension scheme for an employee, it is not a change in accounting policy because new, we have introduced new. So, can we say it is adoption of new policy? Yes, but the question has said classify estimate, policies, extraordinary items, prior period item, ordinary activity. Now, it is not a change in accounting policy. It is of course not a change in accounting estimate. No error, no extraordinary item. It is part of ordinary activities. Change in the reserve for obsolete inventory. Now, reserve for obsolete inventory basically means the loss that we have recognized when we value inventory at lower of cost or net realizable value. This is to do with estimate. So, it is a change in accounting estimate. Settlement of litigation case. Someone has filed a litigation against the company, we have settled it, right? Now, this becomes a part of our business ordinary activity, but this is an exceptional nature because it is related to our business. Actual bad debts exceeds the provision, standard question, change in estimate. Legislative changes having long-term retrospective application. Legislative changes, GST has changes, it has long-term retrospective application. Is it related to our business? Yes, but it is significant, it is material, so it is ordinary activity with exceptional nature. Capitalization of working capital, loan interest. So we have taken working capital, that loan interest we have capitalized, right? Now what is this? This is our error, we have done a mistake here. Change from cost model to revaluation model for measurement of carrying amount of PPE. So selection of measurement cost model or revaluation model, this is our accounting policy change. Government sanction grant in the current year for expenses incurred in the previous year, right? Now government has sanctioned grant has been received related to the business, so it is a part of our ordinary activity but requiring separate disclosure. Or if it is one-off case, see, generally government grants are also related to the business, so it will be extraordinary activity. Or if the enterprise feels that calling it to be an extraordinary because it is one time, it is not expected to occur in the future, then you can classify it as extraordinary activity as well. Now these type of questions, if it comes, attempt everything, 4 to 5 marks you should be targeting. Don't worry about perfection. Okay, perfection has never yielded great results. Can I score 4 to 5 out of 10 questions? That is identification 0.5 each one. Now the next question you may have is, so should we explain? You have to be smart. This question is for 5 marks, there are 10 items. So there is no scope for explanation because identification itself will help you get 0.5 marks. But if a 5 mark question and only 5 items have been given, then for the category that is covered here, you may give 1-line definition or 2-line definition as well. Okay. Is this clear how to approach this question? How much to write? Because a lot of students, what they do is, they will explain everything, they will classify everything, and then they will come back and say, sir, we did not have sufficient time, we could not complete the paper. That should not be the thing. 10 marks, 5 marks, 10 points, very clearly, there is no marks that is given for explanation or justification. Are we clear? Are we clear, all of you? Okay, great. The accountant of Shiva Limited had sought your opinion with relevant reasons whether the following transactions will be treated as change in accounting policies or change in accounting estimate for the year ended 31st March of 21. Please advise him in the following situation in accordance with the provisions of Accounting Standard 5. So here they have said, not only identify, advise him in accordance with the provision, your opinion with relevant reasons. Just a moment. Sorry guys, some small interruption. So now in this question, if you see, as compared to the previous question, here they have said opinion with reasons. So you have to give opinion, you have to also give the reasons. And here if you see, they have given you 5 line items. So for each line item, 1 mark for reason with your opinion. Okay. Sir, will we get half mark for just writing the opinion? Generally, it is not provided unless the head examiner specifically says that you can give, or if the examiner is slightly, if they feel that we should give that marks, then they will give, but otherwise they will not give. Okay. Provision for doubtful debts was created at 3% till 31st March. From the financial year, the rate of provision has changed to 4%. Now here very clearly, here the company has revised the estimates based on the changed circumstances. Thus the rate of provision of doubtful debt is a change in the accounting estimate and not a change in the accounting policy. Then during the year, the management has introduced a formal gratuity scheme in place of ad hoc ex gratia payment to the employees. Now here what has happened? New policy has been implemented. So how should we write? The adoption of an accounting policy for the events or transaction that differ in substance from previously occurring events or transaction. The notes, what we refer to those 2 exceptions, will not be considered as a change in accounting policy. introduction of a formal retirement gratuity scheme by an employer in place of ad hoc gratia payments on retirement is a transaction which is substantially different. Hence, it is neither a change in accounting policy nor a change in accounting estimate. Till 31st March, furniture was depreciated on SLM basis for 5 years or over 5 years. Now they have changed it to 3 years. This specifically is covered as a change in accounting estimate. Okay, then management decided to pay pension to those employees who have retired after completing 5 years of service in the organization. Earlier, there was no such pension. So, we have introduced a new pension scheme. There was no pension earlier. So, this also is a change in, this also is a adoption of new accounting policy. There was a change in the cost formula measuring cost of the inventory. So, that becomes a change in our accounting policy. Are we clear on how to approach? See, my whole idea is in both Accounting Standard 4 and Accounting Standard 5, we should not lose out on marks. We should never lose out on marks. That is the whole idea. Okay. Then, May 22 again 5 marks. TQ cycles is in the manufacturing of bicycle, a labor-intensive manufacturing sector. In April 22, the government enhanced the minimum wages payable to workers with retrospective effect from 1st of January of 22. Now, here we have to be careful about the dates. Okay, which year are we looking? We are looking for P&L for 21-22. So we are talking about 31st March of 22. When did it become retrospectively applicable? From 1st of January of 22. 1st of January of 22. Now I think this is an error here. It is 22-23. Let us see. Due to the legislative changes, the additional wages for the period from January 22 to March 22 amounted to 30 lakhs. So, from Jan 22 to March 22, it is 30 lakhs. The management has asked finance manager to charge 30 lakhs as prior period item while finalizing the financial statement for 22-23. Now, what they are saying? They are finalizing the financial statement for 2022-23. For 22-23, they are finalizing the financial statements. Now, this amount that you have to pay, when was it decided? In April 22, it was decided. In April 22, it was decided. So, in 22-23, it was decided that you have to pay 30 lakhs for the previous period. Now, the thing is it a prior period item or is it an ordinary item or is it an extraordinary item? Now, we have to handle one by one. One is it belongs to the previous period, but it cannot be called a prior period item because we did not have the information when we were preparing the financial statement, right? The second thing is they have not told us when the financial statements were finalized, and here because they have not discussed that, we can assume if we believe that the financial statements were finalized, negotiations were going on, then it can be an adjusting event or non-adjusting event. That is one scenario we can pick up. Okay. Now here specifically, the finance manager is the view that this amount being abnormal should be disclosed as extraordinary item in the P&L. So here we are talking about prior period item and extraordinary item. We have to clarify whether it is a prior period item or not. I already told you when we prepared the financial statement as in 31st March of 22, the information was not available. There was no error, there was no omission. We did not know about it. Hence, it cannot be called a prior period item. So, how do we approach this? First, define the relevant provision. Prior period items are income and expenses which arise in the current period as a result of errors or omission in the preparation of financial statements of one or more previous period. This does not include other adjustments necessitated by circumstances which, though related to prior period, are determined in the current period. This sentence, even if you don't write, it is okay. Now, the revision of wages took place in April with retrospective effect from 1st of January. Therefore, wages payable for the period 1st January to 31st March. It cannot be taken as an error in the preparation of financial statements, and hence this expenditure cannot be taken as a prior period item. This cannot be taken as a prior period item. Then what should we do? That amount should be taken as expense in the P&L for the current period. Now, is it an extraordinary item? Payment of salary and wages is a day-to-day activity for me. It is not an extraordinary item. Hence, it cannot be called an extraordinary item as well. So, you can give the definition of extraordinary item and say why it is not an extraordinary item. but it is what? My ordinary item. But it is ordinary item, amount or nature is significant. Why is it significant? Government has said you have to increase the wages. The shareholders should know, the stakeholders should know. So in that case, what do you should do? Ordinary activity, but exceptional nature, a separate disclosure is required. Right? That is how you have to frame the answer. Now, in the examination, you will get 1 mark for prior period item definition, 1 mark for extraordinary item definition, 1 mark for explaining why it is not a prior period item, 1 mark for explaining why it is not an extraordinary item, and 1 mark for giving you a conclusion that it has to be disclosed separately. Okay. Now, sometimes they make mistakes in financial year. You can assume that this is for 2022, 23. All right. Again, so similar thing what we have discussed earlier. So this you can go through it once. PQR Limited is in the process of finalizing its accounts for the year ended 31st March. The company seeks your advice on the following. Number 1. Goods worth 5 lakhs were destroyed due to flood in September. A claim was lodged September 15. Claim was lodged with the insurance company. No entry was passed in the books for insurance claim in the financial year 15-16. In March 18, the claim was passed and the company received a payment of 3,50,000. Explain the treatment of such received in the final accounts for the year ended 31st March of 2018. Okay. Now, there are two things. One, flood occurred in September 15. Claim was lodged with the insurance company immediately, but no entry was passed. Now, two things are there. One, if you look at Accounting Standard 29 related to reimbursement, when you have to receive some amount from another party, in that case, what you have to also see is if it is clear, if it is certain, if it is virtually certain that you will receive the amount, only then you can record an entry. Now, I can assume that because I have filed the insurance claim and it is virtually certain that the claim will be approved or insurance company has already approved the claim, then in that case, I can say it is an error or omission. But if I believe that it was not certain whether we will receive the amount or not, then it will not be a prior period item. So, depending on the assumption you take, your answer will change. Here what they have taken an assumption is, it's a case of error and omission in the preparation of financial statement. Hence, the claim received in 17-18 is a prior period item. So, this is on the assumption that when we filed the claim, we were sure we will receive the money. We were sure we will receive the money. That is why it was considered as a prior period item. Okay. Then, company created provision for bad debt at 2.5% in preparation of financial statement. On review of the credit period and all of that, they have changed it to 8%. Accounts were not approved by the board till the date of decision. While applying the relevant accounting standard, can this be considered extraordinary item or a prior period item? Now, what is this? This is something where you have changed the estimate. If we have changed the estimate, it is neither a prior period item nor an extraordinary item. Okay, it is an item in the ordinary course of business, and this relates to an estimate. So, accordingly, we will write the answer. Okay, so you can look at the other questions because we have thoroughly understood how to approach, how to write, what is extraordinary, what is ordinary, what is prior period, what is changes in accounting policy, and what are changes in accounting estimates. Any questions, or we will move to the next step.